This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hey everyone, welcome back to my channel. Recently, Hamilton launched 2 new ETFs, further expanding their yield maximizer lineup, CMAX and IMAX. CMAX is a covered call ETF focused on the Canadian market, while IMAX covers developed markets outside of North America. Today, I'm going to chat about these 2 new additions. Before we dive into the heart of the video, I want to take a moment to talk about Moomoo Financial Canada. One feature that really stands out, especially for income investors, is that they are currently offering 0% currency conversion fees between CAD and USD. As many of you know, some of the strongest income-generating products are only available in the US. It allows you to convert your distributions much more efficiently. Secondly, for those who crave a sense of control over their portfolio, the detailed ETF data on Moomoo is excellent. Having that data organized like a digital pay stub is a massive time saver. If you're looking for a more efficient way to manage your income portfolio, Moomoo is definitely a choice worth looking into. Let's talk about CMAX first. My very first impression is that it's essentially HDIV without the 25% leverage. In terms of fees, CMAX doesn't charge an extra management fee on top. It only charges the fees of its underlying ETFs. Since all the yield maximizer ETFs it holds carry a 0.65% management fee, the overall blended fee is also 0.65%. For distributions, based on the current payout of $0.1470 per share, the annualized yield is sitting somewhere between 10% and 11%, paid out monthly. Looking at the portfolio, you'll notice CMAX's asset allocation is very similar to HDIV, but with a few key differences. HDIV includes a wider variety of ETF types, whereas CMAX is entirely made up of Hamilton's own yield maximizer ETFs. The specific breakdown is HMAX at 35%, UMAX at 22%, AMAX at 15%, QMAX at 15%, EMAX at 12%, and RMAX at 1%. There are a few key takeaways here. First, compared to HDIV, CMAX has a significantly higher weighting in the utilities sector, reaching 22%. Second, CMAX also indirectly holds U.S. tech companies through QMAX, rather than domestic Canadian tech stocks. Third, and this is the most crucial point, is the covered call ratio. Inside CMAX, both the financial sector HMAX and the utility sector UMAX use a 50% at-the-money call strategy. HDIV, on the other hand, mixes these covered call ETFs with pure index ETFs like HFIN and HUTS, which have no covered call strategy at all. This dilutes HDIV's overall coverage ratio down to about 30%. A lower coverage ratio means less premium income, but it gives you way more room to capture the upside when stock prices climb. So, HDIV's lower coverage is actually better for maintaining its net asset value over the long term. Now, let's check out CMAX's historical performance. Even though CMAX is a brand new ETF, its underlying holdings have some history. By running a proportional simulated backtest, we can compare it side by side with XIU, which tracks the TSX60, and HDIV. Looking at absolute returns, CMAX definitely underperformed the other two. Over the nearly 2-year backtest period, CMAX had a cumulative return of 60.3% and a compound annual growth rate of 27.87%. This is slightly lower than XIU's 64.6% return and 29.65% growth rate, and also lower than HDIV's 78.4% return and 35.2% growth rate. But honestly, this isn't surprising. HDIV comes with 25% leverage, which naturally gives it a massive edge in a bull market. And XIU, as a pure index ETF, doesn't have a covered call strategy capping its upside, so it makes total sense that it outperforms in a strong market. However, if we switch gears and look at risk-adjusted returns, CMAX actually shines. Its Sharpe ratio is 1.77, slightly edging out XIU's 1.74. Its Sortino ratio is 2.59, beating XIU's 2.51. This tells us that for the same level of risk exposure, the quality of CMAX's returns is on par with, or even slightly better than, XIU's. What's even more noteworthy is the volatility. CMAX sits at just 11.97%, which is visibly lower than XIU's 13.11% and HDIV's 15.09%. As for the maximum drawdown, CMAX hit negative 11.02%, again better than XIU's negative 12.36% and HDIV's negative 14.57%. If you look at the charts during the major market shakeup in April 2025, CMAX's drop was noticeably milder than the other two. So, If you're an investor chasing steady cash flow while hoping to limit downside risk, CMAX is a choice worth seriously considering. It trades away some upside potential for lower volatility and more stable monthly distributions. In a choppy or sideways market, this feature will really prove its worth. Next up, let's talk about IMAX. If CMAX is an unleveraged HDIV focused mainly on the Canadian market, then IMAX targets the non-North American region, specifically the EAFE markets. That means developed countries in Europe, Australasia, and the Far East. For the basics, IMAX officially launched on May 8, 2026. The management fee is also 0.65%. IMAX pays 0.132 Canadian dollars per share, reaching a yield around 10%, and it pays out monthly. For currency, IMAX is CAD unhedged, meaning unit holders need to bear the risk of foreign exchange fluctuations. Looking at the portfolio structure, it's incredibly clean. It holds just 2 ETFs, each making up 50%. Those are the iShares Core MSCI EAFE ETF, ticker IEFA, and the iShares MSCI EAFE ETF, ticker EFA. You might wonder why they don't just go all in on one, since they track highly similar indexes. The reason lies in how they execute the covered call strategy. The 50% in IEFA acts as the long-term core holding to track index performance, while the 50% in EFA is specifically used to write call options. Because they only write calls on the EFA portion, the maximum covered call coverage for the whole fund is capped up to 50%. This perfectly mirrors the strategic logic used for HMAX and UMAX inside CMAX. Geographically, the portfolio is diversified across multiple developed countries. Japan takes the highest allocation at 24%, followed by the UK at 13.8%, Switzerland at 9.5%, France at 8.8%, Germany at 8.7%, and Australia at 6.9%. The Netherlands, Sweden, Spain, and Italy make up about 16.1% combined, with the remaining 12.1% spread across other markets. Overall, this is a developed market portfolio anchored by Europe and Japan. Since its correlation with North American markets is relatively low, it can theoretically provide some solid diversification benefits at the portfolio level. Finally, let's look at the historical performance of the underlying assets. Because IMAX is brand new, we can only look at its underlying holdings to make some judgments. Over the past year and a half, EAFE tracking ETFs like IEFA, EFA, EACL, and XEF all posted total returns between 20% and 25%. XEF was the standout at 25.3%, while IEFA and EFA recorded 21.27% and 20.6% respectively. During the major market pullback in April 2025, the EAFE market wasn't spared, but its rebound was just as strong, showing a high level of synchronization with the Canadian market. As a covered call ETF, it's entirely expected that IMAX won't outperform pure index funds like IEFA or EFA. But given how new it is, we might as well give it some time and wait for more comprehensive market data to validate its actual performance. To sum up, the launch of CMAX and IMAX is primarily aimed at investors who want to maintain cash flow while lowering their risk exposure. On one hand, U.S. stock valuations are sitting at historical highs, so many investors are looking for diversification. On the other hand, non-U.S. markets have performed quite well over the past year, making the EAFE market increasingly attractive. Releasing CMAX and IMAX at this specific time makes Hamilton's market read pretty easy to understand. But if we look at Hamilton's product lineup from a more macro perspective, I feel like these two ETFs are more than just filling gaps in their roster. Based on my observations of how Hamilton usually operates, their new products often serve as accessories to their core flagship funds, like HDIV and HYLD. So, rather than being standalone products, CMAX and IMAX make Hamilton's product puzzle much more complete. I'll make a bold, no responsibility prediction right here. Maybe one day, Hamilton will use HDIV, HYLD, and IMAX as core components to launch an all-in-one, global cash flow ETF, positioned similarly to XEQT. It would cover Canada, the US, and non-North American developed markets all at once, balancing diversification with stable payouts. Of course, I don't work for Hamilton and have zero insider info on their product planning, but I personally think it would be a highly attractive direction. If the Hamilton team happens to see this video, you guys should seriously consider it. As for whether these two ETFs are actually worth buying, it really depends on the individual. For CMAX, if you already hold HDIV, I don't think there's a huge need to make the switch. Their investment logic is extremely similar. CMAX's core advantage is having no leverage and lower volatility, But if you're already comfortable with HDIV swings, switching doesn't mean much. On the flip side, if you really want to lower your risk instead of switching to CMAX, consider just turning off your dividend reinvestment for HDIV. Let the cash pile up naturally to increase your portfolio's cash ratio. It gives you way more flexibility and you don't have to constantly rebalance. IMAX's situation is a bit different. Right now in the Canadian market, products that focus on non-North American regions while providing steady cash flow are definitely few and far between, so IMAX fills that void. However, because it just launched and the historical data is too short, jumping to conclusions right now is a bit premature. My advice is to observe it for a while. Specifically, do a side-by-side comparison with EACL, since they both cover the EAFE market. This will give you a direct look at exactly how much yield enhancement IMAX's covered call strategy actually brings and how much upside it sacrifices. Then, you can make your own judgment on whether to jump in. Alright, that wraps up everything about CMAX and IMAX for today. If you found this video helpful, please hit the like button, leave a comment, and subscribe. I'll see you in the next one.